You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kostrup-Larsen, are delighted to be back with you this week on another edition of the Systematic Investor series, which is our weekly open-ended and raw exploration of the world of rule-based investing, and where we also take some of your questions. So good morning, Jerry, and good afternoon to you, Moritz.
Hi, Niels. How are you?
Doing very well stateside this week. So enjoying some warmer climate for sure.
That's good.
Yeah. Another week, of course, and a bit of action. I mean, obviously a lot of political stuff going on in Europe this week, and the usual news flow from the stateside. Kind of, in a sense, quiet when I look at sort of the week by week performance, but it certainly, doesn't mean that the individual markets were quiet, but just from an overall picture, I don't think much change on our side. We'll get to that. But why don't we just jump into it and see how it all played out from our point of view in this wonderful world of systematic trading. Moritz, can I, as usual, just start with you and see how things were looking on your side?
Sure. Slightly down this week. Think about 1% off. And, it kind of like felt none of the positions that I had on really got any meaningful traction. Made some money on the equities because most of the indices that I trade went down and I had a short position. But natural gas, that was a loser. Didn't make money on the bonds. The currencies, they didn't move that much with the exception of the British pound. Overall -1. Like I said, there wasn't really one clear, nice trend that I had in the last week.
It's kind of funny because we were talking about it last week, where you had a good start to the month, and
yes.
and we were kind of the opposite, and this week it's kind of the opposite again.
There
we had
you
a
go.
good month. Sorry, yeah, exactly. We had a good week, and as some of the markets you mentioned certainly were the drivers. Currencies for us were really the where the action was in a positive way, but short positions in equities. Some equities, were challenging part of the week, even though I think yesterday might have helped a bit. And then, of course, we have the lovely natural gas, as you mentioned, where there's always action going on, and certainly that had a influence as well. But overall, an okay week on our side. And Jerry, how was the second week of December for you as we head into the holiday season, and hopefully maybe the markets will quiet down a bit? Who knows?
Yes, not a profitable week for sure. The long stock, single stock positions, treading water, not going down, not going up. Shorts, a few shorts did pretty well. I do think they still the same story. Any rally in the indexes are going to be sold. Welcome the rally so we can sell them again. And I'm not a chart reader, or don't know if you can pick up too much on that. It's just discouraging, or it's great if you're short. And so it does seem that I have a small stock exposure, long and short, but when stocks are down materially, I'm pretty sure I make more money in long dollar.
Right.
So I always check the stocks first and thinking, okay, I'd like to see this rally stop and start rallying again. But then I say, oh yeah, I'm making money in the currency. So I guess whatever. So a little disconnected there. What I'm rooting for, and natural gas is dominating yesterday with a big move, about 3 ATRs from my original entry point. So 50, 60 basis point loser there in just one market. So that was everything else is just boring and holding tight with the short commodities. And bonds, and no one knows where where the next bond trend is going to come from, up or down.
No, I mean, it has been one of those years from trying to memorize a little bit or looking back at sort of the monthly trend barometer update I do, where I also look at sectors, and I can't really think of any month. I'm sure there was maybe one, but mostly it's been like, and this tracks, the markets in 10 different sectors. And for the most part, I think we've only seen one or two sectors in a trending state at the end of the month at the same time. And so I definitely concur about the fact that, you see one or two things happening, but for the most part, other parts of the portfolio is just doing nothing. And that's obviously an environment that is generally difficult for us to deal with. I mean, we need a little bit more than just, one or two markets to carry the performance. That's for sure. One thing that, I mean, I think it's interesting for hopefully I hope it's interesting for people to listen to this period as well, just to see the difference between 3 trend following approaches, where it certainly seems that we're performing differently at times, and so not all trend following is the same. I think that's the message I wanted to get across. And also, when we look at the trend following world, and even though I think we all feel it's been a difficult year performance-wise, it doesn't mean that all trend followers are down this year. I mean, it very much depend on time frame, very much depend on the markets you have in your portfolio. And this is one of those years where just a few differences can make a big difference in performance. And it kind of spurs my interest in a year like this is always, what's the background, and is there anything we can learn from it? And I think this year is certainly, when we look at it, I think it's one of those years where the optimal look back period, so to speak, is very different than the longer term average, and it's somewhat shorter, meaning the optimal look back period is less than 100 days, it seems right now. Which is on the shorter horizon in compared to what we look at, for sure, and that may explain why many of the medium to longer term trend followers have had a difficult time, but maybe people who've had just kind of the right set of look back periods in their model could have a decent year. I don't know if this is something you've thought of in your own sort of analysis, or noticed anything similar in your strategies so far this year?
Haven't analyzed it, but I'm not surprised by what you're saying. Certainly, one of the reasons I'm down is because I'm trading longer term than the time period that you just mentioned, longer term than the 100 days at least. So if it's been working better below 100, say between 50 and 100, I need to have a look at that. I could actually find that out relatively quickly, just, playing around with a couple of lines of code. But
sure,
I haven't checked that yet. Good idea, actually.
Well, if you do, it would be interesting to see what you find. I mean, it could be driven by also, market allocations, that, you have the right commodity markets. I mean, clearly people who nailed nat gas, I mean, they would have done really well in some months, right? Yeah, or crude oil, yeah, sure. What about you, Jerry? Any thoughts?
That's an exercise we have done over the years. We trade longer term, and we trade multiple longer term parameters. So, but I feel like that they are very correlated, but not so much over a short period of time, like a year, and then not so much when you look at the profit and loss generated by those systems. So every system is long. Natural gas, for instance, or a big uptrend. Since there are none of those, let's say every system is short coffee, and it has 100% correlation. And then all of a sudden, when coffee gets exited, we get out. The different breakouts or moving average, they'll start kicking in. And then if it will be much different P&L for each of those systems, even though they're very highly correlated using a traditional measure. But So yeah, and then we will look at sectors as well. And for instance, I'm pretty sure we looked at shorts last week, and I think over a long period of time, our shorts haven't done very well,
No.
and the grain markets haven't done well. So trend following is bigger than it's a separate subject than CTA diversified programs, but most people feel like it is better to trade multiple systems with lots of different markets. And that's why we have all gravitated towards a pretty diverse portfolio. But small changes and small differences in allocations and parameters can yield big differences over a short period of time.
Yeah. And then, of course, I mean, as we know in our industry, there has been, at least from time to time, this tendency that maybe to overcome some of the shortcomings that we know trend following will have. I mean, then people start adding completely different systems into their overall programs, which changes the profile, but it can be difficult to spot that until, you either have a really bad period for pure trend, or you have a really great period for pure trend. And then suddenly there's a group of people who you start thinking, why are they performing so differently? So, I mean, so that's something people should be aware of as well if they look at this space. So, yeah. Well, interesting discussion, and maybe we'll pick it up if you, Moritz, find anything of interest on that. But why don't we? I don't know about trend changes this week. Not that I haven't spotted any particular sort of things in that category, but I would love to hear a little bit about the world of Twitter, especially your world of Twitter, Jerry, and see how that evolved over the week. Maybe there was more action on the Twitter side than there was in the markets. Who knows? Yeah,
Twitter, can't get rid of it. It's such a big part of our life and mine, and it's fun, and I learn a lot from reading and following other people. This week, I have a couple of tweets. I won't go in order, but so I won't get too confused because there's a lot out there. But one of my favorite ones was one that I just popped out of my head. And I've said this before, and I think it's an interesting thing to think about and debate. And maybe I got this from the Opal-esque article, which we'll also talk about. Was I'd like to see our whole industry, I've said this before, change and to be, here's what I wrote. CTA trend following needs to move out of the alternative and into the mainstream. Real Crisis Alpha is using a trend following strategy on the entire portfolio, especially stocks. And I've talked about this before, but for some reason felt the need to put that out there late at night. And, a lot of people like that. And I think that's sort of the future. We're not a 5 or 10% add-on. We need to take our great systems and trend following and apply it to lots of markets, and especially portfolios that are mostly equities, or even maybe all equities. That's where we're going to actually help people and add value in a material kind of way.
Yeah. No, I mean, it's definitely an interesting topic, and something that I think the three of us, and I'm sure a few more people, will continue to bring up. So what about you, Moritz? Did you have any thoughts about that particular tweet and thought that Jerry brought up?
No, not really. I haven't been that active on Twitter this past week, I must admit. So not much to add there from my side.
Sure. What else got attention in the social media world, Jerry? I definitely saw a few that was very, very popular from you.
Yeah, another thing that I've seen in a couple articles this week was the idea of market timing, and it doesn't work. Nothing, certainly fundamentals, many articles about how fundamental value, the yield curve, inverted yield curve, not good signals to time the market. And it sort of got me thinking. There was an article in The Economist magazine that talks about market timing and that stuff. But I guess I was just wondering, I don't think what we do is market timing. We're not good at timing, since 60% of the trades thereabout are probably losers. So we're not really good at the timing aspect. And I'm using maybe semantics a little bit, but just trying to, how can you have something that's kind of a low success rate, but yet makes money? And I think it's just important that when we see these death crosses or breakouts or new lows, these are good bets to take with your portfolio in a systematic way, but it doesn't mean that it's likely to be correct. I think that the market looks weak, every rally gets sold. It probably doesn't mean a darn thing other than your short system that you're using on the S&P index or whatever stock index. You should do that trade, and over time it's going to work out well for you if you do all those trades in all the different markets. But we're not really a market timing tool, and we don't think probably timing works any more than anyone else. It's not a contradiction, or it's makes perfect sense to me that timing mechanisms and systems are two different things.
Do you think that this is part of the problem, that people do look at us for some sort of timing? Because obviously they look at us getting the timing right when it comes to providing negative correlation to equities when equities go down. So I wonder whether that's part of the problem, that maybe a lot of people, because we're systematic, think of us as trying to time the markets in some sense, from long to short, and therefore ideally should get or be able to provide this crisis alpha when people need it. But in reality, as we're saying, and as you just said, we get things wrong most of the time. So we're clearly not good at timing, but what we're adding is the discipline process and all of those things, the diversification and these things, which is what makes the money over time. And again, I heard a fascinating conversation. I think it's a little bit old. It was a podcast of it was Patrick O'Shaughnessy's podcast, where he was interviewing one of his friends called Ted Seides, who is actually the guy who made the first bet against Warren Buffett. So he was the one who picked 5 hedge fund funds to compete against the S&P over this 10-year period, where the S&P eventually ended up making the most money. But it was a very interesting discussion between that. I've kind of forgotten exactly what point I wanted to make with that, but yeah, so timing, we're not good at that, but we are. Yeah, I think that was really the point. What he was saying is that one of the things that he felt, having certainly had some interaction with Buffett, was that what he really brought to the table, where does his quote unquote alpha comes from in the long run, was not timing or anything like that. I guess you could say that he's bought a lot of Apple recently, and that doesn't seem to be great timing after that dropping 35% from the high. But it's the discipline that he adds to, that he has in his approach over so many years. That's really where his quote unquote alpha comes from. Don't know
Very
whether
much
that
agree.
resonates with any of you. Yeah.
Yeah, and for this, I'm not sure about the name, Ted Seides, that was bad timing for him to have made that bet in, I think, 2008 or 2009, whenever they made it.
That's true, even though he felt at the time that it was great timing. I mean, he felt that the S&P was overvalued. And let's not forget, I mean, the S&P started by dropping 54% after the bet was made. So he was up for a long period of time. It took years before the S&P got back into the lead. But then, of course, the way Buffett, I think, ended up spinning it was, the high fees in the hedge fund industry. Clearly, you would never be able to beat the S&P. So that's a different debate. But you're right. I mean, it's all about timing, and clearly, after, I think the bet started January 1st, 2008. So, of course, after a year and a half, this massive bull market started, and it's been on a tear until recently.
And I must say, I mean, I'm so happy with my timing of being 40% right, 60% wrong.
That's right.
As that sounds, but those 60%, they tend to be relatively small. But then also don't forget, I mean, there are people out there, I'm sure they have better win ratios, but maybe hidden risks in their performance streams, a longer left tail. And then what we don't know is what are the win ratios of some of the discretionary traders. They can't measure them. So maybe a 60-40, like it is for us trend followers, isn't that bad compared to a stock picker. Maybe that guy is 70-30 or something like that, even worse, right? 70% wrong, 30% right. It just shows up in bad decision making and,
but also, as you said, Moritz, which is very true, of course. I mean, even if you had more winners, I mean, if you lose a hell of a lot more on your losers, it's not going to help you to get to that result. So, Any thoughts, Jerry?
Yeah. I tweeted something late at night, something along the lines of, I want to be profitable with the lowest Sharpe ratio possible.
Yes.
And I think that, and people, I think, took mercy on me and said, boy, I could come back with something on that. Like, it looks like you're trying to actually accomplish that. You're losing money with a very low Sharpe ratio. So they were nice and they didn't hammer me. But I think it gets back to there's hidden things going on in track records or in systems that show themselves and that are really unfortunate little bombs ready to explode. We've talked about those. And the Sharpe, what's driving the Sharpe for someone like a trend follower is usually going to be profitable trades, trades that have no chance of hitting your stop loss. You've been in them for months or years, and they're going to be huge monster profits. You're crushing it for the month, year, week, every time frame, and you get back a lot of profit, and you end up having great performance. So that is what is going to make us have a low Sharpe, this 0.5, 6, whatever is typical for trend followers. So that's, that's perfectly great because we don't have these hidden bombs that are going to go off and explode. But then I think I wanted to say that you're talking about Buffett and 50 years of following his approach. It's just so powerful. I know when I first started trading, that was one of the ideas that I was told is that, we have a positive game. We'll eventually win. Minimum boldness. Do whatever you need to do to stay in the game. Keep trading. Keep doing the trades. Trade smaller if you lose. It's very important to be able to do the trades, stay in the game, and not hit a critical drawdown. So this is probably what is a good part of what Buffett made him so successful is that he did what it took to stay in the game for 50, 60 years, ever how long it is. But then I also read an article this week that was somewhat humorous that the guy was listing the characteristics of Buffett in the early years. A one-man shop, no institutional quality, no one helping him. And the point of the article was none of us would have invested with this guy because he didn't fit the mold, didn't look like, someone we should invest in. So I think that maybe has some trend following similarities as well. Long periods of losing trades, doing something like so goofy is just going with the trend, trading commodities on the short side. This doesn't look like something I should invest in. And then, 20, 30 years later, the track record looks pretty darn good.
Exactly. Yeah. And I think also, I can't remember exactly when this conversation that I was listening to took place, but I think the other point he made was that actually, if you look at Buffett, he hasn't actually, he's underperformed the S&P, I think, for the last, 8 out of 10 years or whatever it is. So it's not like he can walk on water either. And I think all the other points that you brought up is perfect. It's about, framing these things and in a bigger picture. And, if we all had to have all the right qualities from the beginning, like I'm sure we didn't have, when Bill Dunn started out and so on and so forth, nobody would ever start a business. But there are people who are crazy enough to say, well, I can make this work, but time and persistence, is a very important ingredient in those early years. Any other tweets? I hope there is some more tweets.
Oh yeah,
they're always
absolutely
good to dive into. And
this is an article I liked a lot. Morgan Housel has a Thursday, Friday on his website, he lists Thursday and Friday, things that caught his attention. And I pilfer a lot of great articles from that site, Collaborative Fund. And the title of this one was Rational versus Reasonable. And the quote is, most investment models maximize for risk-adjusted returns, but in the real world, every investor wants to maximize for sleeping well at night and being proud of themselves in a complicated world. Aim to be reasonable instead of coldly rational. And of course, I love that. I think to some degree, it says lots of things to me. Making money frequently. Don't worry about the drawdown so much on a very positive trade. If the back test and systems say to take small losses and let the profits run and not be too eager to get out, which I think it does, then don't even worry about that drawdown that you're going to have on a very, very profitable trade during a very profitable time. It's about making money. It's about making money frequently. The trailing 12-month rate of return, making that positive 90% of the time, or as high as you can get that number. Because in the real world, this is what people care about, not sharp or not even really drawdowns too much, as long as it's a reasonable number. Trading more equities, I think I can always figure out a way that almost anything anybody says will lead me to that conclusion. More single stocks, people like them. That's what they want to invest in. We find ourselves out in alternative land getting 5 or 10% and then saying something about we can help with crisis alpha. We need to use our trend following models in ways that we can help the most amount of people.
Have you, given that viewpoint and belief that you have, Jerry, have you changed your allocation to stocks within the program a lot over time? Because this has become more and more kind of your I'm not saying it is, but if it was more and more your sort of core belief that people should have more single stocks, et cetera, how has that sort of been reflected in your own program over time?
Well, I traded the single stocks, and I've chosen a fixed portfolio of stocks, trying to keep it as fixed as possible. Companies come and go. And I chose those stocks to try to get the maximum amount of diversification. So optimally, I'll always have some shorts and always have some longs. And then maybe in some tough periods like October, especially, I've definitely had shorts. So I think for all our goal would be for all the sectors to have as many different markets as possible, and our portfolio weightings would reflect that. I don't believe necessarily that I am in favor of trading more stocks, quote unquote, unless it makes sense. How much diversification am I going to get from these stocks? I think to a large degree, because there's 1,000 out there, and there's probably in general, for all practicality, 15 commodities we trade.
Right.
The soybeans and the meal, they're probably the same thing. Crude and heating oil, unleaded, kind of the same thing. So if we just boil it down to the unique drivers of performance, it's probably 15, let's say.
Sure.
But I'm pretty sure that if my universe of equities is 1,000, I can probably find a little bit more diversification in the stocks. So that would, from a pure math point of view, I'm going to trade the stocks maybe a little bit bigger than the commodities, or maybe a little bit smaller, but right around that same amount. So I'm getting quite a bit of diversification from the single names if I can put my mind to creating a universe, a portfolio of single names that are different. Now, of course, we also have periods where stocks crash and all my diversification goes away, but I think it's similar in currencies, commodities, and interest rates as well. So I don't think we can still stay within the mathematics and the analysis of the markets and correlations, and probably increase our stock exposure if we trade single names.
Yeah, absolutely. Great stuff. I'm sure there are more tweets, or I'm hoping there are some more good points that you, I know we haven't even gotten to or maybe we have, but the article you mentioned earlier, there was the article, the Obelisk article, where you had some thoughts and comments as well during the week, as far as I recall.
Yeah, I'm just building on that. One of the
Yeah.
quotes from that article was maybe something like CTAs. Here it is. I think some CTAs have cheated on their base models a little and added more equity exposure. It was either door one, go out of business, or door two, choose to get some better returns. My response, respectfully, of course, actually door three, more diversification, smoother returns, which is what I just got finished saying. You should add market stocks, whatever, to the degree Chinese commodities. That's hopefully one of these days, right? So whatever the markets are, we include them, we size them, we weight them in our portfolio to the degree that they improve diversification. Not there's no way for door two to be correct. We choose to get better returns. I know ahead of time that if I trade more equities, I'm going to get better returns. That's beyond my capability. If it was part of my capability, I'd find it difficult not to have traded 100% equities versus just cheating a little bit and having a little bit more equity exposure. So I don't really think that made a lot of sense. I do think in order for us to get out of the alternative space, provide more value for people, move the needle in a positive way, it's obvious that we can do that by trading a little bit more equities, single names. Huge mistake over the years to relegate ourselves to index trading only. We're missing out on a lot of diversification. And of course, people like stocks. Let's give people what they want. But yeah, I was a little ticked off by that quote.
Yeah, it's kind of I thought also, I mean, when you use words like that, I mean, at the end of the day, we're here to make money for our clients, and we choose the best path that we believe in. So it's, to use a word like cheating is kind of a bit odd in my opinion. Did you read the article as well, Moritz?
Yes, I read it. I read that part of it at least. I haven't finished the complete article yet because it's a couple of pages. But yeah, I mean, I've heard that before, that some CTAs maybe have added more equities to their program. There's no proof for that. At least I can't prove that. I'm not sure if it's true. If it were true, that's their choice. Like you said, I mean, cheating is a hard word there. As far as I'm concerned, I'm trading the equities in the same way as any of the other markets, and I'm trying to give them about the same risk contribution as all the other markets. So I don't make that distinction.
No.
And I think, adding, and another way of putting it is, whoever, not me, but let's say that some people have traded more equities. Good for them. They traded the best markets, the best trends. This whole idea that we need to root against equities, we need to root against a certain sector or markets that's having a great move just makes no sense whatsoever. Once again, it's just rooted in we're going to go for 5 or 10%. It's this crazy marketing strategy that we're going to put us in a traditional portfolio so we can help with you. We're giving up. We have nothing to offer. We have no reason for existing in life except how we impact the S&P. Okay, so I say no to that. I mean, it's, I can do better than that. One of these days.
I mean, yeah, and I was going to say, I think I know where it comes from, right? Because I think to a large extent, our industry has been sold as a hedge to equity. So if you include more equities on the long side, you may not be able to deliver that hedge. But this is where the misunderstanding, in my opinion, starts, because I don't think we are a hedge to equities. We're an independent, hopefully uncorrelated return stream, and which tends to make money when there are prolonged crises. But it's not meant to be, certainly not in our opinion, it's not meant to be a quote unquote hedge. So whatever gives you the best long-term returns, whether it's single stocks or whatever it is. I mean, if as long as we're transparent with our clients, they know what we do, and there are some good solid reasons for why we do it, and we then go on to deliver what we said we're going to do. I think that's what clients, will appreciate over the long run.
It's also because the world benchmarks all of us against the S&P 500 for whatever reason. It's
Yeah.
not only the crisis alpha, but I think every manager out there is benchmarked against the S&P 500 completely, regardless of what they trade, whether that's event driven or global macro or systematic trend following. It's always against the S&P 500, and I think this is where that's coming from.
And I think if you to understand what's going on in the market beneath the index, you have to actually look at it and look at the stocks and see what's out there. And you mean you can have shorts on when the fangs are driving the S&P to all-time highs? Yeah, there was actually shorts out there. And now as the market is crashing, I was buying McDonald's, Walmart, CVS, Coke, Pepsi. Yeah, there's other things going on. It's like saying, oh, you mean to tell me that you could go long natural gas with the commodity indices making new lows? Yeah, of course you can. I mean, it's an index. It's a group of markets. Why don't you just trade the group of the commodity index? No, you're losing diversification. It's not a revolutionary idea. It's a total normal idea that, you know, we and another thing, I know we don't, I'm pretty sure that very few people would look at the back test and overweight markets that have done better, trending better. The sharp of I'm always mystified by the sharp of crude, the sharp of sugar. It's not that at all. We just look and say, okay, crude, what's the correlation of crude to all the other markets? And has nothing to do with past profit and loss. We trade bean oil, which I think has been negative for 50 years. And cocoa probably hasn't made money ever, but it's in there. They're both very unique drivers. They're one of those 15 commodity markets that are somewhat unique and not really correlated to anything else. So we include it irrespective of its past P&L. So you just can't get more robust and safe like that. And obviously in a period where the S&P did really well for most of this year, and everyone knows it's driven by a few stocks, by definition, we tremendously underperformed. We had shorts. We didn't have just those FANG stocks. We didn't have the index. So we're so goofy and crazy that we don't even care. We're trying to find shorts. We know that if we have shorts in a bull market or we have longs and shorts in the different sectors, we have done our job as risk managers, trying to find lots of diversification. I'm not happy now that I'm 100%. Every currency I have on is short the dollar. Failure, nothing I can do about it. That's what the trends say. I prefer not to be that way and to make less money if the dollar itself has a big up move.
And let's not forget that, you know, we talk about, well, earlier we talked about market timing, right? But if we just extend that concept a little bit, I mean, market timing in terms of equities is also relevant, because I think the three of us probably shared between us, there was an article about, you know, the stock charts you never see, or I can't remember the right title of that paper, but where basically they had analyzed stock markets, and where there were many occasions where you had 10, 20, 30-year periods where there was absolutely no performance in the stock markets. And we just happen to be in a world now where the last 10 years has been fantastic for stock investors, and we probably know why that's been the case. And it doesn't mean that the next 10 years will be great. You know, so that is part of the concept as well. We're right now being compared to the best performing sector market, you know, in the world. But maybe if we're being compared to the same market 10 years from now, that comparison will put us in a very, very favorable position. So, yeah.
Yeah, maybe. Maybe one thing there, because you asked me about some news, and I forgot to mention that very late last night, and that's probably the reason I forgot to mention it. But very late last night, I watched the Lee Cooperman interview on Real Vision. Not sure if you've picked it up yet.
It's on my
and
to-do list
he was also
today.
Asked on what's your outlook on the stock market, and you know, I think as humans we'd all say, well, the last 10 years they have been absolutely great for the stock market, and therefore maybe there's a good chance that the next 10 years aren't going to be that good. Okay, fine, that's a possibility. Lee Cooperman said, well, there's also a very good chance that the next 10 years are going to be just fantastic, because he said that compared to interest rates, the current price of the stock market still is relatively cheap. So he just, you know, compared it against the level of rates and had apparently made an analysis of where stock market multiples were compared to the level of interest rates at the point in time. And he came to the conclusion that as of today, the stock market looks relatively cheap. Boom, there you have it. So make up your mind. What's right? Are you going to have mediocre performance going forward or stellar performance? Who knows?
Absolutely.
Yeah, another article I tweeted about this week was 5 lessons we learned in the stock market, or 5 takeaways, and they were pretty complex and pretty interesting rules. And, but then I just said, or you could, it was 5 takeaways from being that we learned from GE, 5 mistakes we made, 5 lessons we made, and I listed the 5. And at the very end, I said, or you could just, not be long in a big downtrend. So I think that's going to work most of the time. These lessons, they come and go, they change. People change their minds about lessons and what are these lessons. Nothing's going to beat the subjective criteria of applying my system. It's going to tell me every time if it's in an uptrend and if I have an edge and I should be buying.
Yeah, I mean, now that we're talking about it, I also now remember something I saw on in social media world, and I think nowadays, obviously, a lot of people have made a lot of money on Amazon, staying in the FANG world. But I mean, Amazon has been obviously one of the best performing stocks. But when you look at the Amazon chart, there is a 94% drawdown. So
Yes.
again, I mean, let's not forget those kind of periods of time where most people probably wouldn't have stayed with that trade when they reached the 94% drawdown.
True.
Yeah.
Well, the most
Any
popular,
more?
the most popular.
Yeah, let's go to the popular ones. Yeah.
Most popular one this week was something I had said at the last time we recorded, and got a lot of love from my followers. I'll get out of this drawdown the same way I got in it, doing all of the systems trades. There is no acceptable substitute. I would do the same trades all over again! Exclamation point. So I like that for many, many reasons.
That's great. I as I mentioned before we started recording today, I certainly saw that and shared that with my colleagues, and it's just so true, and so I'm glad
So did I.
you took that to the social media world instead of just leaving it in our little podcast world. So well done.
I remember back in the late 80s, my mentor being interviewed on CNN. I think they had just had a massive drawdown with some new funds, and the interviewer was shocked that he would say, "Oh, I would do those same trades again. They're great trades. They're fantastic, but they didn't work." Well, there you have it. I mean, or is that how we're going to evaluate ourselves, that these trades didn't work? Well, maybe they were large, maybe the drawdown was too heavy, maybe the risk control was not conservative enough. But all of the trades we did to get ourselves in any situation, positive or negative, they were the right ones to do, because we're all looking at this from a very long-term point of view. So I like that. That's the bottom line for a system trader. You've got to fall in love and embrace the system like it's the greatest thing ever. It's pros and cons. It's like your children who are not always perfect. Everything about them I love. There's not one characteristic that I don't love about those kids. They're mine, and you don't get everything that shaped them and their strengths and weaknesses. And the same way with these systems. If I have a great system and it has a really nice drawdown, I love it. That's what the system does. So I'm going to embrace it and really fall in love with it and be committed to it.
Yeah. The last minute of what you just said, that needs to be a recording for eternity. That's great.
Yeah, great analogy. And I think that also, I think maybe this is probably our biggest, I think, task as people who deal with our investors and our potential investors. If we can somehow make them love or make them really truly buy the process rather than just buying the performance, right? If we can do that, I think we'll have happier and most likely longer term investors. So everything you just said, if we can, make that point, so that people truly agree with us, and so it's not about getting people to say, yes to, our whatever we propose. It's for them to say, that's right, that's exactly right,
Exactly.
and this is why that's why we should have, you in our portfolio. So I think that's our main objective here. But unfortunately, that's not exactly how people are trying to promote this strategy. So anyways, so much good stuff, Jerry. Can you keep going, or was that kind of the?
Let's save something for next week. Yeah, let's save something for next week.
Fair enough. I've got a few performance updates I can share, and these are again as of Thursday evening. So I think Friday was a good day. So these numbers, could be a little bit better than what I'm quoting now. But as of Thursday, the B Top 50 is down 50 basis points for the month of December, down 5.72 for the year. SocGen CTA Index down 37 basis points, down 7.53 for the year. SocGen Trend Index down 1.14%, down 10.01 for the year. The SocGen Short-Term Traders Index up 0.66%, but down 0.86% for the year. And the Bridge Alternative Flat Fee Index is down 1.07% and down 10.82% for the year. What else do you want to bring? Yeah, the reason why I guess we kept going quite a while on the tweets is that we didn't have any questions from listeners this week. So we will just say we are very much encouraging you to send us some questions, because we love a challenge to answer some of your questions instead of just what we thought was interesting. We're very interested in finding out what you think is interesting in this world. So by all means, tweet us the questions or send them to info@toptradersunplugged.com so that we can dive into some of those next week. But any sort of final thoughts before we wrap up? Anything to look forward to? Anything that has come up in our conversation that we should that has inspired you, Moritz and Jerry, to touch on before we wrap up?
Well, I'll think about it. Maybe next week we'll take a deeper dive into things.
Yeah, that's fine. Sounds good. Good. Well, on that happy note, so to speak, happy trading note, you forgot that, Moritz. I mean, what's happening here?
Well, we're thinking about closing up. So now here it comes. Happy trading.
Happy trading. Okay, good. So, well, thanks so much anyways to all of you for being with us on another edition of The Systematic Investor. And if you felt you got some value from today's conversation, please do share them with your own followers. And of course, we're always grateful if you would leave us a honest rating and review on iTunes so that we can spread the word of this particular podcast series. From Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.